Morning, everyone. It is 10 o'clock, so I'll call the October 7th meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda is approve the minutes of the meeting of September 10th, 2015. I've got a move in a second. All in favor? Aye. All opposed? Motion carries. Item 3 is to receive the report of judgments purchased for the month of August 2015 in the amount of $80,595. Second. A motion and a second. All in favor? Aye. All opposed? Ayes have it. Item number 4, we've got 2 items. We'll take those together. Second. Got a motion and a second. All in favor? Aye. Ayes have it. Item number 5 is to approve the claims docket for $29,000. Have motion and a second. All in favor? Aye. All opposed? The ayes have it. Item number 6 is approve the following applications for service retirement. We have 8 this month. Have a motion and a second. All in favor? Aye. All opposed? Ayes have it. Item number 7 is to receive the report of death and authorize the payment of the $5,000 death benefit and approve continuation of the pension to the spouse. We have 1 case. A motion a second. All in favor? All opposed? Item number 8 is receive the report of death, authorize the payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 3 cases. Motion a second. All in favor? All opposed? Ayes have it. Item number 9 is to receive the report of death, authorize the Secretary to make necessary changes to conform on the following. We have 2 cases. Have a motion and a second. All in favor? Aye. All opposed? Ayes have it. Item number 10 is approve the following application for vested rights. Have a motion and a second. All in favor? Ayes have it. Item number 11 is to ratify approval of the following to terminate vested rights and receive a lump sum payment of their employee contribution account. Have a motion and a second. All in favor? All opposed? Ayes have it. Item number 12 is discuss and or authorize, and we'll take these separately. Item A is the affidavit and agreement of Ruby Tolliver in regard to retirement benefits owed to Tim Tolliver. Wiley, anything we need to know about this?
I had one question. Yeah, I noticed on the hold harmless, she has a time frame for 5 years. Is that normal? Does it have a time frame on that?
Well, that would be a breach of contract kind of statute of limitations.
Okay.
And anything that's going to come up from some other person is going to come up during that time frame.
Okay. Thank you.
This is pursuant to the statute that authorizes these settlements under $20,000.
Right.
Any other questions? Do I have a motion?
I'll move it.
Second. We have a motion a second. All in favor? Aye. All opposed? Ayes have it. Item 12B is Warburg Pincus Private Equity 12 Limited Partnership Private Placement Documents. Jason.
Okay, thank you. Before we get to the documents, not to be putting the cart before the horse, I think we need to talk about the recommendation. So you have... well, Wiley will do that.
So, I already talked to Wiley about it. He said he spent the weekend looking at it.
He did, I know he did. He spent a little time on it. So you have in front of you this book, Private Equity Program Review and Recommendation. So just before we talk about Warburg Pincus specifically, we want to spend a little time going over your private equity program as a whole and the purpose of it. So As you know, you have a 5% target allocation to private equity. Private equity fund vehicles operate differently than your traditional large cap and small cap and international equity in that you make commitments to fund these vehicles as opposed to if you're going to invest 10%, you just move 10% to a large cap equity manager. Here, you make a commitment of $20 million to be paid to that manager over a 3 to 5 year period. They call it down as investment opportunities arise and then invest that capital into companies. As those companies mature or they improve or capital markets are sufficient to do an IPO or to sell to a strategic buyer, they will ultimately sell all of the companies in the portfolio that they've purchased, and when they sell those, distribute money back to you. So it's not necessarily recycled. And I say that not necessarily because some partnerships do allow for the recycling of some capital early on in the partnership life. So if they invest in a company and then sell it pretty early in the first couple of years, they may recycle that capital into new investments. So in effect, if you make a $10 million commitment to a fund, you may actually be able to invest $12 million if they're recycling capital. And the benefit of that is that you only pay fees on the $10 million and not $12 million. That's the other difference. Fees on private equity funds are on committed capital, not invested in the early years. So you're actually paying for money that's not yet invested, but that's really when the heavy lifting is done, when the partnership is out identifying companies and then making the investments. That fee waterfall begins to go down as the partnership matures. So after so many years, you're not paying on the commitments, you are paying on invested in the later years of a fund. I think there's a question.
So logistically then, after we commit the funds, what are we doing with the funds that haven't been drawn? How are we managing those funds?
So they're invested in accordance with your asset allocation. So we know if we look right now.
So it's still managed in such a way that you can work through this strategically to
yes. I mean, we
not
know,
put ourselves in a situation that we're having to sell out of something at a bad time, that you're managing the funds to ensure that we've got a sufficient amount of capital that where their next draw is coming, that we'd have the ability to pull that from something that's more liquid.
Right. Well, because your portfolio is primarily in liquid investments, you're never going to get a call that's 5% or 10% of your total fund.
At the size.
Right. The capital calls may be 5%, maybe 10% of the commitment. So if you think of a $20 million commitment, a 10% capital call of $2 million would be still very easily accomplished based on the liquidity in your overall portfolio. And that most likely would never happen. Most capital calls are in the $800,000 or $500,000 to $1 million range, depending on the.
So originally, then, when you make the commitment, you're paying the fees on your commitment as well as the fees on that committed capital and whatever investment it's still in.
The fees generally work. It's a percentage of the committed capital up until a time that the investment period, what they call the investment period, is over. And the investment period is generally the first 3 to 5 years, depending on the partnership. After that, then it backs down to invested capital. So it's going to the fee will go down. So if you make a commitment of $10 million early on, that 1.5% or 2% management fee is on $10 million, but by year 5, it's on whatever is invested, and that number is generally going down because they're selling. As they sell businesses, they're distributing capital back to you. The numbers that you see in your ASAP report and that we show in this review are all net of all fees. This is the net return to you, so there is no gross numbers. So through the end of September, you've made, for every dollar you've invested in private equity, you've got $1.48 in value, so about a 50% cumulative return. And you are we would describe where you are in your the evolution of your private equity allocation as very immature. You're very early on in the development of this private equity program. Your first commitments were in 2009. So really, if you're thinking about a 3 to 5 year investment period, you're really just now getting to the point where some of these investments will be realized and you'll start to see the benefits of the private equity. One of the ways we mitigated some of what's known as the J-curve, because early on in private equity, you have fees that's impacting your value, and you're not having realizations. So one of the ways we were able to mitigate that was a significant portion of your early commitments went to distressed within the Sigler Goff Fund. So distressed, investing in distressed companies or distressed investments has a shorter life cycle, if you will. Typically, you're buying mature businesses in a trough, and it just, when the economy comes out of that trough, it's a little bit quicker, versus venture capital or early stage investing where you're investing in ideas and new technology or things. That has a little bit longer timeline to realization. And so you've mitigated some of that by that Sigler Goff investment, which was also April of 2009. You made a $5 million commitment to that. They've drawn 4.9. They've returned to you more than your commitment. You've gotten $5.2 million back of a $5 million commitment, and there's still about $2.3 million in value there. But just, if I could, just walk through this in terms of the planning process, talk very generally about what you've done so far. But if you turn to page 7, what we're trying to do with the private equity program, much like your equities overall, we want to build a diversified portfolio across the private markets. But we look at it a little bit differently than just small, large, U.S., non-U.S. Really what we're trying to do is invest across the economic life cycle of a company. So the early stage, new technology, new ideas is venture capital. That is the highest risk, highest reward, longest time horizon to realization. So you're getting some of that through Warburg Pincus. Warburg Pincus we'll talk a little bit more about, but you are in one Warburg Pincus fund already. Very diversified, and they're actually investing across this spectrum as a whole, which is fairly unique among direct private equity funds. As you move along the life cycle of companies, you get into more mature businesses or more manufacturing or maybe we'd consider them old school businesses that have been built up as family businesses or may need some financial leverage to improve them. That's where we get into the growth equity and buyouts. Oftentimes you hear the term leverage buyouts or management buyouts, and these are more mature businesses. To that falling off, where mature businesses have fallen off and become distressed. So good businesses, mature businesses with bad balance sheets, and this becomes an opportunity in various times of the economic cycle, particularly in periods of time after recession. Oftentimes, that is the best time to invest in private equity. One of the other things we're trying to do, not just diversify across types of businesses, but diversify across time as to when we put money to work. We can't predict when is going to be the best time, but if you think about what you're doing, you're staging money in to the market or to private equity investors that are staging money into businesses to be able to take advantage of different periods of time in the economic cycle. Oftentimes, there is a disconnect between when it is a good time to invest and a good time to own. The last year or so has been a very good period for private equity. There's been a lot of M&A activity, a lot of technology IPOs. So if we, I think it's the next page, yep. If we look at the next page, 8, this is a history of returns of all private equity by vintage year. So this is looking at some databases, Preqin, which is a private equity database that measures returns of different funds. So what this is looking at isn't, so let's pick 2000 or 1999, for example. That's 7.2%. This is not indicating that the return of private equity in 1979 was 7.2%. What that's indicating is that the return of funds, private equity funds created in 1999 that began investing in 1999 through now, through March of 2015, have returned 7.25% or 7.2%. So that's the worst year overall over the last 20 so years within private equity. Well, you think about what was happening then, that was the peak of the tech bubble. So massive amounts of capital were flowing into private equity at that time, chasing too few deals. And what that did, it pushed down the results over time of those funds. If we broke this up into venture, growth equity, buyout, and later stage distressed, probably wasn't a lot of distressed investment going on in 1999, a lot of venture. Venture returns would look even worse than that. They're going to be closer to zero. But if you move forward to looking at 2008, 9, 10, 11, which is really a lot of the vintages that you're in when you began your private equity program, pretty robust returns. That's because those funds that were created in 2008, 9, 10 were putting money to work really after the global economic meltdown at prices that were much more attractive. So what we're trying to do ultimately, again, we can't time this perfectly, but what you're trying to do is you're trying to reach your target allocation of 5% and ultimately maintain that target allocation, but do that by diversifying your investments over time, vintage year, by staging in over time, and by type. So if you would turn to talk a little bit more about your portfolio, page 13, just another way to view things. So you made your first commitment in January 2009. When we started, your first commitment was to a Mesirow, which is a diversified fund of funds. So Mesirow is investing in about 40 different partnerships across that spectrum, from venture capital, buyout, and distressed, and some other what we call special situations. Highly diversified, probably have well over 1,000 companies in that fund of funds. But you have two layers of fees there. You have the fund of fund fees and then the underlying manager fees. When you're just starting out, because of minimum investments in a lot of partnerships and to get diversification, we thought it would make sense to use fund of funds. Your second commitment was to Singular Guff. That was what we would consider to be a more niche fund of funds to the extent that it's focused on a particular opportunity set at that time, which was distressed companies globally coming out of the recession. They're not raising money all the time because they're very opportunistic in the sense that they want to find when there are these distressed opportunities, and then they'll raise capital. Probably will be another opportunity for that in the next year or so, where we think they'll be coming back with another offering. And then your third commitment in 2012 was to Warburg Pincus Fund 11. Warburg Pincus is a direct fund, meaning you're investing in the actual a manager or a fund that is investing in companies, not other funds that ultimately invest in companies. Warburg Pincus is a globally diversified, primarily what they would describe as a growth equity manager, but they're actually investing across the entire spectrum, and I'll give you some examples of that. For a fund of your size, still minimums for a fund like Warburg Pincus are fairly high. We're able to negotiate that minimum down by aggregating some different clients. So their minimum is $25 million. You were able to come in at $7.5 million to their first fund. We're going to make a recommendation for $10 million to this fund, still well under that minimum. But it does provide you with very diversified exposure to the private equity markets domestically, globally, and across the business spectrum, over 260 companies in the fund that you're in. What this page 13 is showing is The green line is your invested capital. So you see that's grown. That's kind of, that is representing, if we look at the ASAP or in the quarterly report, we have this column that says adjusted ending value. So that invested capital is representing that, the invested capital is representing the drawn to date, so how much you've put in. The current value is representing the adjusted ending value. So that's the carrying value of the current investments. And then you see what the distributions are. So distributions have begun to grow. We expect those to continue to grow. But as distributions happen, money comes back to you, that will ultimately start bringing the invested amount down if you don't continue to make commitments to new funds. Page 14 just shows some results. These are a little bit dated. The results in the ASAP are more up to date, but of your 3 private equity investments, all of them have done what we would consider to be very well over this period. Like I said, you started at a very good time. Right after, in 2009, was a good period to begin putting money to work. I would say that more often than not, this early in a private equity program, you wouldn't necessarily expect to see this good of returns, because you'd still be in the early stages of building businesses. You're 6 years into the program. Because you've got a couple of fund-of-funds, that's really the average life or average weighted life of some of the companies in your portfolio is probably closer to 3 years rather than 6 years, because Mesereau and Sigler Guff and Warburg Pincus were putting money to work in companies in 2011, 2012, not all of it in 2009 and 10. But you can see we look at a couple of different variables there. Net multiple to cost, which is essentially for every dollar in, how much value do you have today? Those are all close to 1.5 for the older funds, Warburg Pincus at 1.2. A net IRR, that's just an internal rate of return, so the percentage return based on a dollar weighted as dollars go in, a little bit different than the returns that you see in the ASAP, which are time-weighted rates of return. But 12.78% since inception through the end of July. I think it's, I'm not sure if we have that number in the ASAP through the end of September. 11.7 through the end of September for private equity. One of the things, if we just compare to public markets, though, your return for private equity at the end of September of 12% annualized over 5 years, about in line with the S&P, which is up 13.3. The last year, it's been very attractive because public markets have gone down and your private equity has held value and actually gotten some distributions back. So these metrics that you see on page 15 have changed a bit, where the S&P is down now over those periods. Page 16 is probably the most important page in terms of planning and how we look at the private equity portfolio and private equity program. So what we've done here, we've developed this, what we call, it's a pacing plan analysis. And what we're trying to do, based on what we know of the terms, the general terms and conditions of different types of private equity structures, vehicle structures, how they're going to call down capital, what reasonable conservative expectations are in terms of return and distributions back to you. How do we figure out how much you need to put to work every year in order to get to that 5% target and then maintain it, but not go way over it? Because one of the things that you're concerned about is if you overcommit, if we said, well, 5% of your portfolio is roughly $40 million, well, why don't we just make a $40 million commitment and be done with it? Well, we know we want to stage money in over time, but we also want to be cognizant that what if public markets go down like 2008? And so the denominator, or what we're basing these percentages on, goes down, but you've got a commitment amount that doesn't change. You've contractually obligated yourself to commit these dollars going forward. We don't want to end up at 10% or 15% in private equity or illiquid investments when our target is 5%. So we very conservatively test this, and we know we're going to be, this isn't going to be accurate to the dollar. This is just a planning tool. But what we're showing in this model here, at the bottom left, your projected portfolio value, which is actually your portfolio value today. We're growing, basically grow the portfolio at about 2.5%, I think is what we're doing, not 7.5%. I know that's your return assumption, but your assets aren't growing that much because you're spending money too. So we use about a 2.5% growth on the assets. 2015, which we're at the end of, we show a $10 million commitment to special situations with different types, and the types matter because the cash flow of different types of fund structures tend to be a little bit different. So we're assuming special situations, which is a fund like Warburg Pincus, in this case will be Warburg Pincus, corporate finance, which would be buyout. We could also do venture. We could also put in fund of funds. The assumptions we're using on the cash flows would be a little bit different for the different types of funds. But ultimately what we come up with, and what's in that blue bar at the bottom, as we're testing this, about $7.5 to $10 million a year, based on where we are today, we think that's a comfortable number. That percentage of the portfolio in private equity bumps a little bit up over 5%, but not much. So basically, this is a way to test a number that we're comfortable with, not necessarily the manager, but what we're saying is somewhere between 8 to 10 million a year we think is a comfortable number today to get to that 5% and maintain it. That could change if we go on another good run. That number may need to go up. If markets go down, it will come down. The next page looks at your current private equity structure. So thinking about in terms of the business cycle, we've got two bubbles in here that aren't filled really. So the TBD, to be determined venture capital strategy. So right now the Mesero, that's a fund of funds. So that covers a pretty wide swath of the private markets. Some venture capital, buyout, not necessarily getting into credit or distressed, but a pretty wide swath of that. And it is investing in some early stage, smaller VC funds as well as smaller buyout funds, which we think is attractive. Because within buyout, you could be investing in companies that are 20 to 100 million, or companies that are 500 million to 10 billion. There could be some big companies in that space, and they have different different expectations. Warburg Pincus, the fund that you're in, the 2012 fund, primarily growth equity, but just to give you some sense of what they're doing, as I said, this fund that you're currently in, May of 2012 fund, they've made 65 investments in this fund, primarily focus on a handful of industries: financial services, healthcare, energy, and technology are their primary industries. But from a business cycle standpoint, 7 investments are in later stage growth equity, 35 in what are considered growth equity, and then 19 in early stage. So early stage, think of Microsoft or Apple in the 70s, that type of investment. And just some examples of this in the fund you're in. The largest investment, also globally diversified, 50% in the U.S. and almost 40% in Asia. So a lot of China and Southeast Asia exposure. Largest investment in the fund, or the biggest realization to date, is in China auto rental. It's basically Hertz or Avis of China. They made a $200 million investment. They've realized $530 million on that investment. So actually sold it and got that money back for a 76% IRR. So that's a big kind of later stage business. The second largest investment was in Venari Resources. This is an offshore Gulf oil production company. Made a $360 million investment. They've taken $7.6 million out of it. Current carrying value, even after the price of oil going down, is $660 million, so about a 2x return on their capital. Kudai Corporation, this is China, a combination between Amazon and Groupon type of business, so e-commerce type business. This is $29 million investment. Current carrying value is $600 million, so a 22x. Now they haven't taken all that money out. That's what their carrying value is. But the point of highlighting some of these is to show very different areas within industries, but also some small early stage companies as well as later stage growth companies. So in terms of a manager or a fund that gets you broad diversification within the private markets at the direct level, we think this is the premier way to go. We put these two other bubbles in here just as kind of placeholders as we're thinking toward next year, and the next year some areas where we might want to add some things. Potentially a more niche fund of funds that gets into some of the smaller early stage venture and get a little bit more diversification there. And then also looking within the energy sector. One of the things at the conference last week, we did have several firms, Warburg Pincus being one, Apollo, and NCAP come in and just talking about opportunities in energy. If you think just about what's happened to oil prices and energy companies, it's going to be a fairly decent time to invest if you have, the term heard a lot of those managers using last week was dry powder. We think the private markets is probably a better way to play energy than public markets, where you're going to have a lot of volatility going up and down, and these managers looking at some opportunities within the next year or so that might be complementary in your portfolio. So I've kind of mixed in the comments on Warburg Pincus, but we would make a recommendation to what we would consider to be a re-up, so a follow-on commitment to this next fund of Warburg Pincus. Our recommendation is to make a $10 million commitment to Warburg Pincus Private Equity Fund 12. The tab 3 of the book has our summary write-up on the firm. As I mentioned, they're a global private equity firm based in New York City. They've been around since 1966. They raised their first institutional fund in 1971. Very large organization, 470 employees, 70 managing directors, private firm. The CEOs, Charles Kay and Joseph Landry, and then the president of the firm is someone you've probably heard of, Timothy Geithner is the president of Warburg Pincus. The fund, in terms of the fee structure and all of the terms from an investment standpoint, I know Wiley will talk about from a legal standpoint, the terms are all market or above, investor-friendly terms. This fund is it's targeted to be a $12 billion fund, so very large, which allows them to make the kind of investments they do at scale. It is oversubscribed, and we'll have one close. They started marketing this in September. They're going to have one close in November, so the time frame on this is fairly short. We just got all of our diligence done in the last few weeks and have gone through the documents and the meetings with the team. So I say that because it's a pretty short time frame. In advance of this, we did have Warburg send their legal documents, the subscription documents, to Wiley for his review, and he's also gone through that. So subject to, first of all, are there any questions about the private equity program or this particular fund itself?
Is this fund structured the same way the previous fund is, so it's just kind of a continuing next generation of the same concept, strategy?
They have to come back to market every few years. That's kind of their how private equity works, because once they've run out of capital, they've invested the prior fund. It's not quite fully invested.
But do some private equity firms, do they have different strategies in different funds, or do they typically follow the same strategy in every fund that they have?
Typically follow the same strategy in every fund they have.
Okay.
Unless they create an offshoot or specialty fund based upon some opportunity. And I say that because Apollo, who was another manager there, they're generally, they would be the opposite of Warburg. Think of Warburg as your growth equity or growth investment within private markets. Apollo is more value, deep value. They're going to focus on just things that are distressed or that are trading cheaply. But they'll also have themes across a number of different industries. They have created a spin-off energy fund, energy-only fund, because of the opportunity in energy right now. So they think they can raise, they think their main fund that is going to be highly diversified across a lot of different things, they don't want to put 50% or 60% energy in there, but they think they're going to have that much opportunity to invest in energy, so they create a carve-out for that. But generally speaking, funds are going to follow the same strategy and approach that they've done.
So what are you thinking in terms of our strategy? Like if you look back at the bubble graph, as far as us taking an opportunity to get into energy?
That's why we put that on here. These are forward-looking,
Right.
as going forward, maybe having a dedicated energy strategy, and that's what we put on page 18 as we're looking for, because this is a never-ending process. That's one of the things you have to keep in mind. We're continuing to look and identify funds that make sense, but we want to be cognizant of the pacing budget, if you will. So in 2016, we've kind of highlighted looking for a dedicated energy strategy, maybe a small to mid-market fund, so moving down in the buyout space to a smaller buyout, so capture a little bit of that market, and potentially a dedicated non-U.S. The other thing we didn't put on here, but it's on the prior pages, and it's probably not next year, but as we move forward, a venture-only fund of funds. And I say fund of funds and venture because it's a little bit more challenging for public funds to directly access venture funds because of FOIA rules, and it's just a little bit more challenging. So hopefully that answers your question.
Jason, a question, please. We're talking about $10 million.
Yes.
On page 23, it says their minimum is $20 million. How do those two?
Because we've negotiated with them and leveraged with multiple clients that are making commitments to them.
So your firm's going to have over $20 million.
Well, our clients, yes.
I mean, your clients.
Yes, and so they've looked at that as, okay, well, if you have multiple clients that come in over that amount, we'll let some in for less. And we're recommending to you a $10 million commitment. That may, even if you choose to do that, it may get cut back some because they have, like I said, they're oversubscribed, so they may have to ration some of that out. This is a very attractive fund and firm, so it might get cut back a little bit. But ultimately, what you're doing is you're committing to fund up to that amount over the next 10-year period. It may never be that amount.
If we implement the two new strategies that you're thinking about, will we need to increase our percentage commitment to private equity?
No.
We could do that within the 5%.
So you're saying that you're
benchmark.
doing that $7 to $10 million a year?
Right. I mean, so that plan, I mean, we show, I probably didn't make that clear, but in that plan, we're showing on page 16, we've got in 26, and these calendar years aren't hard and fast. I mean, the better way to look at this is a 8 to 12 month pacing plan of about $10 million over each of those periods of time. We've plugged in $10 million for 2015. We're at the end of 2015. You probably won't actually, even if you make this commitment and close in a November close, no money is going to go out in 2015. 2016, that's a new $7.5 million commitment. 2017, another new $7.5 million commitment. So these more niche strategies, a small buyout or an energy-only fund, we'd probably scale those down a little bit, not make them $10 million, but probably more in the $5 million range because they're a little bit more niche-y. if you will, but certainly you're anticipating continuing to make commitments over time. So I guess the next step, if the board were inclined to accept our recommendation, is subject to legal review, and I'll turn it over to Wiley, because I know he's been in contact with Warburton.
I did take an opportunity to read all of the documents over a long weekend, but the documents themselves from a legal perspective are very similar to what we've seen in their prior commitment that we did, and in Misero and Sigler Gulf, private equity funds. Realizing that they draft these documents for participants of all different kind of entities. So we don't have a whole lot of bargaining power with changing terms. But they're pretty standard in the industry, so I didn't have anything major. I did negotiate with them a private side letter that addresses some of the issues that would be important to us from a public entity perspective in dealing with public record laws. Everything you have is marked confidential. They believe that to be proprietary and protected, and they recognize we have an Oklahoma Open Records Act, and that it'll be their responsibility. I have to notify them if there's a request for any of the information, and they will assist in defending their position that it's privileged and confidential. So by agreeing to these terms, the documents that I think Renee provided to you to review are considered confidential, and you may either want to destroy them or return them to Renee or whatever you want to do to protect that side of it. I also secured from them a clause on limitations for indemnity. Their documents were pretty fair in that they always say, to the extent permitted by law, we'll indemnify them. I make it clear to them that under Oklahoma law, public entities are not subject to indemnification. But they're more than willing to do that. And I also got them to agree. I understand that they'll get partners from all over the country, so they can't do litigation in 50 different states. But if for any reason they were to sue us for something we did or some breach of contract term, they've agreed to do it in Oklahoma if they sue us individually. So I did get that small concession from them. And I'd be glad to try to answer any questions you have beyond that.
Jason, I've just got a real brief question regarding the incentive fee of 20% on top of the management fee. If you could just comment on that briefly, that's in line with the industry standards.
Sure. Yes.
How they come to that.
It is. And that's really what we like to see, is that more of the compensation to the partnership is coming from the incentive fee or the carried interest than the management fee, because it really aligns their interest with yours. They're not getting paid unless you are. And that's, sorry, yep. And that also comes with a hurdle that you have to be over 1.25 times the value that you've put in before they get that carry interest. So that it's standard, B, it's, I think, encouraged. You want more of that to come with more of that than management fee, particularly for a large firm like this. It's actually a little bit lower than standard. Typically, you see 1.5 and 2, or for smaller funds, it could be as smaller new funds that might only raise $300 million or $200 million. Oftentimes, you're seeing management fees of 1.75 to 2%, and that's because they're smaller organizations. But all of the numbers and returns that you see, we show the net, since inception, this is on page 24, the net IRR of all of their funds is 17.6%. The net multiple to cash on cash is almost, it's 1.9 times. Those are net of all their fees. And it is expensive, and this is also one of the reasons why where we can leverage some of our other relationships to do direct rather than fund-to-funds. We think that does incrementally help, because if you add fund-to-fund fees on top of that are typically going to be, the management fees are going to be a little bit lower, 50 to 100 basis points, but they may even get another 5% carried interest. So that eats into it a little bit. More niche strategies, the Singular Gulf strategy, while fund-to-funds, they do some things to mitigate some of that double layer fees. They'll do a lot of co-investment, so they're investing alongside some of the underlying managers directly in companies for about 40% of the fund, so you're not paying fees on that. So where we can, we want to do that. Ultimately, you need to have diversification, and we want to get it the best way we can, but not pay too much for that diversification. And we think this allows you to really cut out a significant portion of the fees for equally good diversification.
So, Jason, in order to make the November close, you need an action from us today.
Yes.
Okay.
You would need to, the closing would be a document closing. I think they just want to see documents back actually by November 2nd so that they can review them and make sure they're all in order. And the actual close would be on November 19th. I don't think there's going to be a funding then, but you would need to have all of your documents in order.
All our ducks in a row.
Yes.
So to speak.
Yes.
Okay.
So again, just our recommendation is to make a $10 million commitment to Warburg Pincus Equity Fund 12.
Well, given what we've heard, do I have a motion to move forward with the $10 million funding recommendation? Motion a second. All in favor? All opposed? Ayes have it. Very good. Item number 13 is investment consultant report.
I'm not going to talk about private equity.
Yeah.
I won't talk much. The September report is very preliminary because of how early we are in the month. Clearly, it was a challenging month, as we would expect. Your portfolio held up a little bit better, but still down almost 2% for the month. On a one-year basis now, you're slightly negative, down 41 basis points. Benchmark's down about 1.8%. So things, diversification and some of the protection you have in the portfolio is benefiting you pretty significantly now and protecting on the downside, primarily long-short equity. Your long-short equity investment with K2 is up 5.5%. Private equity, not surprisingly, it's benefiting you, but that's primarily an accounting function because private equity lags, valuations lag, so you've got positive almost 15.5% in private equity where public markets are down, S&P's down 60 basis points over that one-year period. So positive, but it's not for the reasons that it's not from a return standpoint necessarily. Everything else is really, it is protecting, but everything is down. So far in October, we've seen a little bit of a turnaround, but we continue to expect some bumpy roads. Asset allocation continues to be pretty close to targets. You're actually slightly over target to fixed income now as equities have come down, have sold off more than fixed income. So I think going forward, for your monthly cash needs, we would not recommend taking it from small cap any longer, as that's turned around a little bit. We would suggest taking it from fixed income over the next month or so. And the Western portfolio primarily is Core Plus is about 4% overweight now. I know this. if we were back right in line, it's easy to take from the index funds, but right, as volatile as the markets are, we're trying to manage that allocation to what's over and underweight. No real issues with managers, just a couple of the conference, again, thank you all for allowing us to help out. The feedback we got and the evaluations was all pretty positive, very positive, with the exception of the sound system being a major challenge for the 2 years in a row. Not really sure what that's all about. And I know some of it is speakers not getting right up on the microphones, but I think the facility had some challenges with with it. But all in all, evaluations were great. I know everybody loved Louise Gates. She got rave reviews. The attorneys and Hank Kim always get rave reviews. Some good comments back. I think there were some things some folks thought maybe a session on audit would be good, and that's something we haven't had before. I don't know if that was you, Jim, but wanted that. Right. But so we'll pass all that information along. But again, you guys did a nice job, and I think everybody was real pleased with the conference. So.
Well, thank you for your efforts and all that you all did in getting that organized, and Renee for her effort and work in coordinating and administrating that. It was good.
Thank you.
I'll second that. Okay, item number 14, comments from board staff and citizens. Hearing none, we are adjourned at 10:51. Thank you.